Hello students, this is Professor Vincent Osaya. Welcome to my class. This is the presentation of part 2 of chapter 3. As you know, chapter 3 zero in on 3 issues. Number 1, audit planning, 2, types of audit test, and 3, materiality. Now, let's take a look at planning the audit in details. Now, we are told here that the auditor will develop an overall audit strategy for conducting the audit. And the auditor will determine what resources are needed to perform the audit. The question is, what is an audit strategy? We said that the audit strategy is the big picture approach on how to conduct the audit. It is the action plan. Now, let's take a look at the second bullet. It said the audit plan is more detailed than the audit strategy. Basically, the audit plan should consider how to conduct the engagement in an effective and efficient manner. So the question is, what is the difference between audit strategy and audit plan? A very good illustration that somebody came up with is look at audit strategy as the approach that you are going to use when you are traveling. So if you decided to travel, one option would be to take a plane. One option is to drive. Another option is to take the train, so on and so forth. So if you decide to fly, that is your strategy, all right? So now, if you decide to fly, then you have to go ahead and go online to make the reservation or call the travel agent to make a reservation. By the time you get to the airport, are you going to rent a car or are you going to take a taxi? Or call a relative to pick you up from the airport. So those are the details that you have to take care of if you decide to fly. So the audit strategy is the big picture approach on how to perform the audit, while the audit plan zero in on the details on how to go about performing the audit. Now, moving along, let's take a look at additional issues that need to be addressed during the planning phase of the audit. Number 1 here, assess business risk. Number 2, establish materiality, consider multiplications, so on and so forth. So let's take a look at those issues one by one. The first one is we assess the business risk. So we are to the auditor is to understand the entity's business. What type of business is this client involved in? What type of transactions do they normally carry out? That is part of assessing the business risk. Then the auditor also needs to identify the financial statement accounts that are likely to contain errors. Why? So that the auditor can pay more attention, allocate more resources in examining or investigating those accounts. So that is what assessing business risk is all about. Moving along, another important thing that we need to do when as part of planning for the audit is to establish materiality. Recall in chapter 1, we indicated that there are 3 fundamental concepts in performing a financial statement audit. Number 1, audit risk. Number 2, materiality. Number 3, evidence. We said that materiality is the information, or we said that information is material if omitting or misstating it could influence the users of the financial statement. So we said that that is materiality. Now, also recall the generally accepted auditing standards require auditors to plan and perform the audit in such a way to obtain reasonable assurance that the financial statements are not materially misstated. Now, moving along, that the financial statements are not materially misstated. Therefore, it becomes very important that we need to establish what is material from the outset. So that is one of the reasons why it is very important during the planning stage of the audit to establish materiality from the outset. So we are going to establish overall materiality. We are going to talk more about that in due course. Then we're also going to establish tolerable misstatement for account. Tolerable misstatement is, we use tolerable misstatement when we are talking about a specific account. In other words, that is the meaning materiality. So we talk about materiality as on the whole, for the financial statement as a whole. Tolerable misstatement when we are dealing with individual account. Then of course we also establish a tolerable misstatement for disclosures. So moving along, another important thing that we need to consider from the outset when we are auditing a company with multi locations or that has different business units is to consider the locations or the areas that we are going to devote more resources to. Now, the question becomes, how do we know the areas that we need to devote more time or attention to? It depends on the risk relative to that particular location. So from the outset, the auditor will determine the areas or the locations that have more risk, so that resources can be properly allocated for those locations in order for us to conduct an effective audit. Now, another important issue that we need to consider as part of our planning is to assess the need for specialists. Now, what are we talking about here? Sometimes we need some specialists to assist us in conducting an audit. The use of an IT specialist is very common, okay, and it's also a significant aspect of most audit engagement. Why? Because of the advancement in information technology, a lot of companies' accounting functions are so heavily automated that we don't deal with pen and pencils anymore, all right? So and some of these clients have information technology structure that are so complex that you sometimes need an IT specialist who could be also a CPA or not a CPA to help you navigate the whole situation. Now, of course, it is also possible that other types of specialists might be needed. Now, another important thing that we need to consider as part of planning the audit, we need to consider, the auditors need to consider violations of laws and regulations. Why? Because if a client commits an illegal act, that illegal act might have direct and material impact on the financial statements, or it might have material, or it might be material to the financial statement but indirect. What does that mean? First of all, what are illegal acts? We say illegal acts are, an illegal act is something that is against the law. So we need to consider as auditors whether the company has engaged in something or an act that is illegal. Now, why should we care? Let's take a look at direct and material. What are we talking about here? The illegal act could have a direct impact on the financial statement, and it could be material. So what do we mean by direct? Let's take a look at the example. Would be tax laws. So if the company indicate on their financial statement that they owe the IRS, the Internal Revenue Service, $10 million, whereas they actually owe $30 million, then that illegal act is directly related to the financial statement. It's part of the financial statement. And it is also material, assuming that that difference is material. So, as auditors, we need to consider laws and regulations as part of the audit. In other words, we need to watch out and assess the possibility of illegal acts. Now, on the other hand, an illegal act could be material. In other words, the amount could be significant enough whereby it will be material on the financial statement, but indirect. What do we mean by that? For example, a company violates the federal government employment regulation. For example, the company wound up discriminating against some individuals because of their race. If a company does that, that does not have a direct relationship with the financial statement, but if that entity or client is caught and the government wind up sticking to them $80 million in fines, then that might wind up ultimately affecting the financial statements. So it's an indirect impact and it could be material. So as auditors, we need to just watch out for the possibility of violations of laws and regulations. So moving along, how do we know? So here are some information or circumstances that might indicate an illegal act. So as an auditor, you find out that the corporation has not filed their tax returns for the past 2 years. Obviously, that is illegal. All right. So another thing is, when you browse the client's general ledger, you see that they issue a lot of checks to their law firms. Why are they paying their lawyers? You might want to take a look at it. Okay, it could be possible that they are in some mess with the government, hence they are paying a lot of money to their legal counsel. All right, so that's some of the information or circumstances that might indicate an illegal act. You can go through that yourself. Now, let's take a look at the related parties as another issue. 1 second, please. So, moving along, related parties, what do we mean by that? In other words, during the course of planning for an audit, the auditor should make inquiries to see whether there are some related parties transaction. What does that mean? Meaning a transaction between the company that you are auditing and some parties that are related to the company. Now, what are some examples of parties that could be considered as related to the company? So, for example, the company has an automobile and the company decided to sell it. And the chief financial officer said, I'm interested, or the chief executive officer said, I'm interested in buying this company's car. And he or she decided to buy it. That is a transaction between the chief financial officer or the chief executive officer for that matter and the company. So the chief financial officer is a related party. So they gave us some examples of related parties here. So take a look at the 5th bullet, management. Take a look at the 4th, principal owners of enterprise, so on and so forth. So I'm not going to go through all these bullets. So those are examples of related parties. Now the question is, are related parties transactions illegal? The answer is no. In other words, are they okay? Are they legal? Yes, they are perfectly legal. So if they are legal, why do we have to search for those transactions as auditors? Here is the answer. If there are related parties transactions, the management is required to disclose those transactions. Of course, we already talked about notes to the financial statement, the disclosures, right? And of course, the auditor needs to assess whether those transactions were carried out at arm's length. Arm's length meaning without bias. All right. So those are the issues relating to related parties. Another issue. I think this will be a good cutoff point for part 2 presentation, and we'll take it from here in part 3.